is the Hong Kong dollar with the United States dollar. There's a currency peg, a crawling peg, that's maintained by the HKMA. They've been able to keep the rates within this band for the last 30 years. Last time it hit this height was in 2005. A lot of the depreciation that's occurred in the Hong Kong dollar is mostly what they say, HKMA says, it has to do with the mortgage problems that they had in April and the equity collapse that happened recently, and the trade war with China, or the bantering from Trump with back and forth with the tariffs. Also, it has to do with interest rates in the United States are going up, tightening is happening, so dollars increasing in value. And the Chinese stock market, the Chinese equities, the economy of China impacts Hong Kong. This is the offshore renminbi. The Hong Kong dollar is now being used as a proxy for offshore renminbi, and the manipulation or depreciation of Chinese currency is might be another factor too. All those put pressure on this peg, on the upper band. So when you trade this situation, you have a 10 pip spread, typically, with a 1,000 pip profit if you're selling, or 1 to 50 would be a double your investment. Here would be 50% of your investment. If you have 1 to 100 leverage, then that would be double right there. So the intelligent thing, in my opinion, you could play the macro trade and wait for 2 years and then have your profits, which isn't a bad idea. This is a weekly chart. We'll go down to the daily chart, and you can see that although this is 1,000 pips run up, you also have all these multiple opportunities, the hiccups in price and appreciation and depreciation that happened over the years. That would be actually a lot more profitable to be trading in these zones than just holding one trade. Alright, so this is a 4-hour chart. If you look at it, scalping has always been said to be irresponsible. Scalping with high leverage, irresponsible. This upper band is being defended by $1.8 trillion. There's enough United States dollars for the HKMA to buy back every Hong Kong dollar in circulation. So they have ample backup. Yeah, so if you did trade this, you would have $1.8 trillion backing your support. If you traded off these fluctuations, if you sold here, sold here, sold here, very simple, selling here, that's about 200 pips. I think it might be 250. The risk is very low. You'd be gambling on the currency peg not breaking. If you're a contrarian, you would be betting against $1.8 trillion of foreign currency reserves. Alternatively, you could be buying at these lows. That's when you'd actually be taking on risk. I think it's good to be risk averse, but it's also an intelligent idea to look at this situation and assess the risk against a $1.8 trillion support peg.